From Wall Street to managing hundreds of millions in client money, Nick and I use our alphabet soup of credentials to discuss the investing and tax strategies that actually work. Oh, and we played Division I college football together, so strap in. This one hits hard. Let's go.
Alrighty, folks, we haven't had the opportunity to catch up with Taylor from Life Goal Investments in a minute, and I have a laundry list of things to run through with him, so it'll be interesting to see which one he wants to start with. But before we get started, Taylor, how you doing? It's been a minute. Hope all's good.
Everything's great, my man. Business is great. Family's good. We're having fun. Weather's getting nice. We're coming out of hibernation. Markets are crazy, so there's a lot to talk about. Let's do this.
So I got a list, I don't know, of 8 or 9 things. So I have stagflation, deflation, private credit, rate hikes, inflation, 200-day average, AI job loss, Iran, 60-40 portfolio having worst month since 2022. Where the heck do you want to start?
I don't know. We're going to take them as you fire them at me because that is just too much. None of this was known to me, announced to me prior to this conversation, but let's do it. You pick them off one at a time and we'll go to work.
Yeah, well, let's start with probably the most pressing thing, which is the conflict with Iran. Again, you have just this morning, President Trump coming out trying to talk down the market. It feels like the stock market believes him. Although I would argue that other parts of the market don't believe him. Obviously, we also have heard the Houthis are now joining the fight. And I don't know about you, but it certainly seems to be getting worse, not better. But what say you? This has been going on for roughly 30 days now.
Yeah. I think that we have poked a beast that might be more prepared than what we anticipated them to be, with a threshold and a tolerance for pain for higher than what we anticipated it being. I think that this is a very tough thing for him to tackle. And I think that's a scary proposition. And I think that the market has reacted to that over the past 3 weeks. The first 2 weeks were, okay, we're in this. We're going to send some missiles. We're going to take out some facilities there, some of their key leaders. And then I think that the market came to this realization that this is more serious. It's more ingrained. If we're going to do anything with legitimate nature and have any point of finality on any of it, this is going to be a more drawn out thing. And that's what's scaring the hell out of the market.
Yeah, I want to echo that because, again, it seems to be, I think there was maybe in some faction, people thought this would be another version of Venezuela. You kind of go in, get out, surgical, it's over in a weekend, maybe a couple of weekends. I never thought that. I have receipts. I've been talking about this since the beginning. This was going to take longer. I also had the horrible feeling from day one that boots on the ground would be required. And that's just another level. Yep. And it's a level, frankly, that I still don't want to see, but I think is coming. And, then you're going to have, now you have just other parties joining the fray. And the big thing for me that I don't think a lot of people understand, it's not U.S. and Iran. It's U.S., Iran, and Israel, and now maybe the Houthis. And once you start adding more and more players, the less and less control. Even though we have the biggest stick, it can get out of hand really quickly.
I think that we have not realized that Iran, in them poking everybody through a kind of terrorism type stance over the past 20 years, 30 years, 50 years, for whatever reason, they also have dug in themselves. And they knew that at some point there was going to be an offensive that came at them that was superior to their abilities to defend themselves. And so they had to get really, really creative as to how they were going to protect themselves. And I think that we're realizing that there is more there than what met the eye to begin with. I think that we were a little arrogant on the front end of this, thinking that we would pull Venezuela. And the reality is, I don't think that we can leave, because if we leave now, Iran is in control of the Strait of Hormuz.
Exactly.
And until we could rightfully say that, no, we have control and we are bilaterally controlling it with XYZ other country, they are so dug in around this. And when we hit them, they basically said, they flailed. And they said that our only defense to this superior attack is to go at all of our neighbors. Now, they weren't necessarily friendly or unfriendly with the neighbors, but we are going to go scorched earth on global oil supply. And that is their only defense. And that is something that they're holding their guns to. And so now we come back at them and say, okay, you go scorched earth on them. we're going scorched earth on you. That's the threat. And, it's not in the United States, we don't realize how fortunate we are. So you see this massive separation in oil prices in WTI, which is West Texas, and Brent, which is global. So you have now a 10-point higher percentage jump in Brent than you do in WTI, which is showing our prowess as an oil producer. But it is more pronounced in the liquefied natural gas space. The liquefied natural gas that they are bringing into Europe right now is up roughly 60 to 70%. We're down. We're marginally down with our liquefied natural gas domestic prices since the onset of this war. So we don't realize that, and you can understand why the Europeans are rightfully saying, we don't want anything to do with this because we're bearing the brunt of this. You guys are not.
Yeah, that's been one of the things I've been trying to get my audience to understand is this is going to be this is now a worldwide impact. My fear is it jumps to worldwide conflict.
Right.
Right. You start to drag in other parties because they're suffering. And, pretty soon, I don't know how many got to get together before you have World War III. But I agree with you. This is all about the Strait of Hormuz. I don't see how this gets better before it gets much worse. I don't know how you can take those islands without boots on the ground.
And
it's just bad.
The other big outstanding factor is I think that the world has to realize that this is roughly a proxy war as well. So this is us against the East, and the East being China and Russia, and predominantly China. Mm-hmm. So I don't know. There's a lot of gray area. You can read a lot of things that come from slightly suspect sources, but it seems like China is supporting Iran, not only by buying.
Well, they have 80. Oil. Just follow the money.
Well, and I'm not even just saying that, though. I'm not saying just the purchase of the oil, which is the massive support that they absolutely need. But I think that there's probably military intelligence that comes from China towards Iran as well. And they look at this and they're like, hey, I'm not saying we're best friends with Iran, but hey, if our enemy, our largest enemy, which is the United States, the global power of the world, if we can support someone that's attacking them, by all means, let's do it.
So we'll close on this topic because we could probably talk about this for an hour by itself, and we have a whole laundry list of things to get to. I'll close on this question. Do you have any hope that this is over and put to bed by the end of April?
If it is, I don't think the United States comes out with a good look, right? Because there's no way that Strait of Hormuz has any certitude that we are controlling it versus Iran controlling it by that point. We need to go in and really, unfortunately, to your point, use boots on the ground. I just don't see it happening. I think you're right.
All right. Well, we'll move on from that. Again, we can catch up on that next week. How about the 60-40 portfolio? This I'm kind of having flashbacks to 2022, I think it was, where the 60-40 portfolio was flailing. March, again, we have 1 or 2 trading days left, but I just saw over the weekend the 60-40 portfolio is having the worst month since 2022. What say you?
Yeah. Bonds getting cooked. Like, that's the reality of it. Usually, and this happens during periods of uncertainty and heightened nervousness of investors. What you have is correlations coming to 1 on, and it's gold too, right? Gold selling off as well, which is an interesting one. You would think, hey, we're going into a foreign country. You would think there's going to be flight to quality, flight to safety. That's gold. Sure. It's an inflationary pressure. You would think that's a flight to gold, but it's not, right? And so at the end of the day, the market's looking at this and saying, 1, there is so much uncertainty right now. It's funny that you still see earnings expectations by the major analysts on the streets increasing for the S&P 500, even with all this uncertainty that's outstanding, even with oil prices shocking higher 50%. You have this massive uncertainty outstanding. They still have earning expectations going higher. Now, I think that that's what analysts are saying, and I think the market is questioning it because it doesn't make sense to get a pretty significant sell-off in short order against the backdrop of earnings expectations going higher. But it's really the inflationary pressure that the market's worried about that's causing bonds to sell off. Bonds predominantly trade on inflation expectations. And it's funny, the difference of inflation expectations that you can see right now. So 1 year out, 12-month forward, inflation expectations went from 2.6, and they started moving up, ratcheting up before the war was actually officially outbroken. And you have them move from 2.6 to 5.2, which is a massive move in short order, right?
That's nuts.
And so with that, markets start to digest, hey, if I have a bond and, inflations are going to be higher, therefore new bonds are likely to be coming to market at a higher interest rate, I'm going to sell that bond
Mm-hmm.
and potentially buy a new one. So that's what's playing out there. But it is interesting when you zoom out and you look longer term. You look 5 years out, inflation expectations really haven't moved absolutely any. And so I think that probably bonds in the short term are overcooked, oversold. But we've talked at length, Michael, and you watch enough of our channel on social media that you see that we talk all the time about the value of alternative assets. Alternative assets are that harbinger, that safety point during a period of inflation. They were in 2022, and they are right now as well.
Yeah. And that's why I think what you guys do at Life Goal Investments is so important, because you don't lean on the 64-40 portfolio because it's easy. You do the hard work and find the alternatives that perform, and that's not doing well. So again, shout out Life Goal Investments for doing that. Let's talk about the market breaking the 200-day. I mean, everybody on Wall Street, every chart person has to be looking at the 200-day. We broke that. It kind of feels like this is the first leg of a downturn, probably like past times. COVID 2008 will have a relief rally, but then comes the second leg down. Yeah. Is that kind of what you see out there?
Yeah, we were just talking this morning with our investment committee, and it's funny that you just have this, like, if you're actually watching me, you could see my hand move, this just kind of rolling over. It's not like there's this massive just gap downwards. The market's been, it's effectively where it is right now since September of last year, and it kind of rose, and then it wasn't this like snap downwards. It's just this kind of rolling over, and usually a rolling over that's really smooth and really persistent like it's been doesn't come with this all of a sudden pop from a bottom, bang, and we're back off to the races. It just doesn't make sense. That selling pressure is slow and steady right now, and slow and steady selling pressure doesn't beget rapid reversal buying pressure that causes markets to zoom higher in very short order. That's just not how markets digest things. So the 200-day moving average is kind of that level of demarcation, and now we're beneath that level of demarcation. And so it goes from being support when you're above it, where the market bounced down and it hits it and it bounces off of it, and it really is hard to break through that 200-day moving average. But once you've broken through that 200-day moving average, it goes from a floor to a ceiling, and it's really hard, and there has to be some real catalyst in order to propel it back through to the high side.
Yeah, I couldn't agree more. Again, it's going to be very interesting to watch. Again, I think the president is obviously very much, he looks at the stock market. It's clear he does. He's trying to talk up, that the conflict is near resolution. It certainly doesn't feel that way. The chessboard does not look like we're in immediate winning position. I'm not saying we're not going to win. I didn't say that. I said it doesn't look like we're winning today. Like, you can't declare victory today until you get control of the strait, and it's like it was before. You can't declare victory. At this point, that is victory.
Yeah. Yeah. And I at the end of the day, like, let's call a spade too. Like, we don't really know what we're being told is true or untrue, right? Because, before it's like, hey, we're in talks with Iran, and Iran's like, no, we aren't.
No, you're not.
And so I'm sure, regardless, there are certainly talks that are going on. There's no doubt about it. What are we,
we're not even sure who we're negotiating with. That's one thing that I think is who's really in power. It's probably, I would imagine, when you start taking out 80% of the senior leaders, there's probably factions of the juniors going, no, it's mine. It's mine. No, it's yours.
Yeah. And the other question is, like, do they actually put at the helm who they think they actually want at the helm? Because that's like the beheading slate.
Yeah, it's who's next?
Your enemy number one. Like, do you want to put your best guy in that spot, or do you actually have someone that's beneath the surface that's really running the organization, the IRG? I don't know the answer to that.
Yeah, well, let's talk about the Fed next. That wasn't actually on the list, but I want to put it there because I actually said something. It looks like I got it right after the Fed meeting. I made this call on the dot plot, and let me know what you think of it. So again, the dot plot comes out, the SOP. And they basically say inflation is going higher, but also is growth. And what I said that the next morning was, nobody got this. Folks, you missed it. The Fed just told you they're going to hike, right? These rate cut ideas are off the table, right? You're not going to cut when GDP is up and inflation is up. They're trying to set it up. And now since then, the 2-year notes hit 4%. I actually went on my channel and already said I was wrong about 2026. I was on record saying 4 rate cuts in 26. I now think we will have one rate hike in 2026. So what do you think about that? Do you think the Fed really did a dramatic 180?
Oh, I think they did a dramatic 180, but I think there is zero chance in hell we get a rate hike this year.
Okay.
So we went from 3 rate cuts to now, to your point, the 3 rate cuts being priced in the market, 2.5, call it somewhere between 2 and 3 rate cuts being priced in, to now a higher likelihood of a rate hike than a rate cut.
Yeah, there are 0 odds of a rate cut all year as of this morning.
Yep. Yeah. So I think you have to zoom out a little bit and understand what's actually at play here is the way I view it. So we have this massive spike in inflationary pressure based on oil prices going higher. And I think that when you look at things in short order, oil drives inflation higher. There's no doubt about it, right? There's oil in everything, not only the gas pump and the prices that we see there, but also literally everything. Plastic is a function of oil. Everything that gets delivered has diesel associated with it. Everything we use is plastic and oil related. But at the end of the day, if you have sustained higher oil prices, what that does is it takes a discretionary dollar away from somewhere else being spent in the economy.
Amen.
And it puts it at the gas tank, and it puts it as higher prices on the underlying goods that we consume. Longer term, sustained higher oil prices is a deflationary pressure.
100% agree. Yeah, it's demand destruction. That's exactly.
Correct.
Yeah.
Correct. Correct.
Yeah, but there is a lead lag in all of it. So I'll just play out what I see again on my chessboard. So again, first off, we'll start with CPI. CPI comes out Wednesday.
Yep.
No, next Wednesday.
Yep.
And last reading was 2.4. I believe it's going to have a 3 handle.
Good.
Yeah, I think it's going to have a 3. It might even have a 3.1.
Good.
Again, the base effect is nothing. It's going to come in at a 0.6 or a 0.7. It's just like, guys, it's just math, right?
Yep.
It's just math at this point. So I think CPI is going to be screaming. Then they have a Fed meeting at the end of the month. They're going to do nothing, right? 1 month is nothing. But the next 3 months are pretty light base effects. So a 0.5, a 0.6. We could have a CPI back at 4% in 90 days.
Yeah. Yeah.
It's just math. And I don't know how the Fed doesn't, because this is what again, just the chessboard. So that happens over the next 90 days. The Fed is boxed in, and I think they're going to deliver that 1 rate hike. But to your point, what will already be happening is demand destruction, because every oil crisis since the 70s, actually since the 50s, has led to a recession.
Yep.
So I think what happens is, yes, we get this 90-day pop. It looks artificially screaming higher. The Fed is forced to react. Then the recession things hits, and they go on a massive rate cutting cycle in 27. That's kind of what I see.
I think there's so much political. So I don't think that's a stupid thought. Let me be clear. There you go, Michael. You're not a complete moron. I don't think it's a crazy thought, but I think at the end of the day, you also have to realize that there is a massive political pressure for the incoming Fed chair to cut, right? So they're not going to cut. Let me be clear. If inflation's moving the wrong direction, they're not going to be cutting. I completely agree with you upon that. But at the end of the day, to your point, like we have to have learned some sort of lesson from the rearview mirror. You cannot fix supply side shocks with higher interest rates. But it's not to say that it absolutely couldn't happen. I just think that if you have a market selling off and then you couple on top of it higher interest rates, which tightens credit markets, it gets nasty. And we know that there's a massive K-shaped economy, right? And the K-shaped economy goes back to the fact that we know that the lower end of the K has been in trouble. Mm-hmm. The higher end of the K has been sitting incredibly pretty because financial markets have made us richer and richer, that top shape of the K.
But that's exactly why I think they're going to be forced to hike. It's because the lower end of the K is not in the stock market. The lower end of the K is not in these other assets. They don't give a rat's ass that we're 5% highs. They're not involved.
Yeah, but what happens to credit card debt and stuff like that when they start yanking higher on that?
Yeah, it again, I don't think it'll be an easy decision, but I'll still stand on and call it 1 rate hike this year. And to your point, I think it becomes a knee-jerk reaction that forces them to cut very quickly thereafter, because to your point, you can't have this strangle of the economy and then strangle it again.
But by the way, they've done this in the past.
They have. I know
they've done this in the past. Like we know that the result isn't good. So hopefully we paid attention to what we've done in the past and we've learned some lessons along the way. But it's funny, Kevin Warsh, at the end of the day, like he was a long-term hawk.
Yeah,
So
he absolutely was. He wants to shrink the balance sheet. I don't think anybody's picking up on that. He wants that balance sheet, which is also going to drain liquidity.
yep. He doesn't
Yeah.
want the fake QE that we have going on right now
No, he
going
does
on.
not. No, he doesn't want that. All right. Well, I have inflation on the list. My thoughts on inflation, obviously, it's going to print a 3 handle this month, and I think there's a chance that CPI headline hits 4 in 90 days. Is that out of the realm of possibilities?
No, I don't think it is, but I also don't think the Fed gives a shit about what headline CPI says, admittedly. So I think they're just going to back everything out and say, we're going to look at core PCE, which the oil isn't going to have a massive impact on. The food that is going to see higher prices based on higher oil costs
Not going to be
and
there.
fertilizer not passing through the Strait of Hormuz, which we haven't talked about that.
Yeah.
But there's more supply bottleneck there than just oil in that strait, and fertilizer being another massive one, which is going to cause farmland, to not be as productive, and therefore you're going to have higher food costs.
It's coming.
Yeah.
And lower yields. And I mean, it's just all kinds of bad.
Yep. But I think at the end of the day, I guess my point is, I think they just look right through it and they say, hey, we're not focused on this. I did think one thing was really interesting in the last Fed meeting. And it almost feels like Jay Powell's just, taking a shot everywhere he can at Trump now, just because Trump crushes him all the time. But he said, listen, the other thing that we have not fully chewed through is the remaining outstanding tariff kind of inflation that he made a highlight of that several times. And he said, hey, why haven't we had this inflation rollover that we expected? We expected tariffs to be a one-time bump, and we haven't fully chewed through that yet. So he casted some shame on Trump and Trump's tariffs policy. But yeah, and that still, exists. But I think broadly speaking that they stare right through the oil costs increase on headline, and they just focus and dial in on PCE and focus their attention there.
All right. Well, let's get to the big one. I remember, I think you and I joked about this 6 or 9 months ago when Jerome Powell said, I don't see the stag or the inflation.
Yeah.
I don't know how you can't look at today's environment and go, there's some stag and there's some inflation. What say you?
Yeah. So he had a funny comment the other day, and I think he addressed it pretty darn well. He said that I talk about stagflation. He said, if you want to make the argument that inflation is going, at the time, not materially higher, the inflation is creeping higher, and that unemployment is ticking up modestly. He said, yes, you could broadly define that as some very light form of stagflation. He said, I define stagflation what happened in the 70s. Right. And I think it's fair. I think that we are really parsing data. And at the end of the day, like inflation now, mind you, like this shock that's coming right now that is going to come, to your point, it should be at least relatively one-time oriented, and oil prices move higher. They might sustain longer. I get it. But at the end of the day, this is an exogenous event that caused inflation to move like it did, or like it will, rather. And I think that it can be largely stared through until it persists, right? And if it persists, then it becomes a problem. And then on the unemployment front, it's one of those things where we don't have massive hiring or firing right now. So it's kind of that subdued market, and you don't have employment growth almost whatsoever. If you look at history, there's never really a time outside of kind of recessionary leading into coming out of environments where there's no hiring. But we've also made this massive shift in our immigration policy. And so it's kind of a net neutral, if you will, where hiring and firing are both really, really low, but that's a function of where immigration came from. And Jerome Powell spoke to this. And I thought he did a pretty decent job. But yeah, if you want to start picking through the numbers and saying, I can't see stag or inflation, I think you can. It's just modest still.
Yeah, I would argue wait 30 or 60 days. It's going to be screaming in your face.
So which side of it, to be clear?
Well, I think inflation is clearly going to be. I think higher oil leads to lower production, right? And we're going to get there next. So I don't know, right? You got inflation at 4%. You have GDP sub 1. That's like the definition on the screws of stagflation.
It is. That's fair. I think that you don't see any kind of material bleed through. Listen, the economy could have been slowing before. Let me be clear on that.
Oh, no, yes, I think it was. But yeah.
So and I tend to agree on that. But at the end of the day, like the slowdown in the economy that we're going to experience from this event is not going to be for some time, right? That's as I see it. Again,
that's a Q4, Q1.
Yep. Yeah. That's that longer term. Yeah. People can start to not afford things, and it bleeds through. I think that's kind of how you have to view that.
Yeah. Well, let's get to that deflation demand destruction. Because again, I think what people don't realize is oil shocks really are demand destruction and cause deflation, which just blows everybody's minds. How would you kind of at a dinner table or a restaurant tell a friend, yes, you have a bump in inflation, but let me tell you what the big boogeyman is, and that's deflation. How would you kind of tell that story?
Yeah, deflation seems like the world's greatest problem, and until your economy goes through it, right?
Yeah.
If you don't believe us, ask the Japanese who went through it for basically 30 straight years, and their
Yeah.
economy
Crazy.
didn't
Yeah.
didn't grow one iota. At the end of the day, it's not hard to look back and say 10 out of the last 11 recessions were a direct function
Oh,
of
yeah.
oil price spiking. And so oil
Clearly. Yeah.
prices spiking causes economies to slow down. That causes deflation, right? And if the deflation is sustained and prolonged, that is a much bigger problem, although it doesn't seem it, than prices going higher. If you realize Michael and Taylor sitting here and we're like, hey, we could go out and make that investment, or we could just keep our money in our pocket for a year
Cash.
and then go out
Yeah.
and make that investment.
Yeah.
That's how an economy truly slows. And why would you make an investment now if the anticipation is that prices are going to be lower 12 months from now? You won't. You'll wait. And that is a function of sanding the gears of the economy, driving it to a screeching halt.
Yeah. Again, yeah. In my fear is oil is still over $100 and probably hits 150 in the next 6 months, because I don't see a short into this quagmire, which is really unfortunate. And then to your point, I think it becomes a worldwide recession, right? You already have the Philippines and Thailand declaring emergencies, right? Europe is going to fill it with natural gas. This is going to be a worldwide deflationary spiral, perhaps.
Yeah, yeah. And again, this is one that it'll be very interesting. To my point before, I don't think there is an easy taco out of this, to be clear. But I think we're going to try to taco our way out of this. I'm not entirely sure how you do it politically. You could certainly, one of the things that Trump has intelligently done is not drawn a line in the sand as to this is our goal.
He can't
Like
come back.
hard
Yeah.
and fast. This is what we are here to accomplish. I think that at the end of the day, now it's become a straight Hormuz game. But I think going into it, it probably was more likely we want to seize the enriched uranium,
Yeah, probably.
which was
Yeah.
the nuclear kind of facility, and making sure that they don't have the ability to do anything from a weaponization on the nuclear front. But now I think this is becoming more economic duress, and our focus has potentially shifted away from the imminent threat of nuclear behavior to this is an economic, disaster. And now they're quote unquote letting a few ships through as a appeasement. I can't make sense of that at all.
Yeah.
So I'm not sure entirely what's going on there, but I guess back to my point of like the ability to tackle out of this is still there. I don't think it's the right thing to do necessarily at this point, but it's still there because we have not said we are in Iran to do X, Y,
Yeah.
Z.
We haven't defined the victory, so we can declare anything victory.
Correct.
Yeah. Makes total
Correct.
sense.
And
Well,
Trump is the greatest marketer of all time.
Yeah. Let's switch gears to something kind of in right field based on all the other conversation. That is private credit,
Yep.
right? There are lots of people seeing what's going on with private credit, a lot of funds, kind of hitting their limits and gating withdrawals. Lots of talk about AI investments in software companies, that being kind of the apex of the pain. What are your thoughts on what's going on with private credit today?
I think there's a massive misunderstanding of private credit. Massive misunderstanding
Okay.
of private credit. So two things. Let's talk about AI software spillover into private credit into that space. So one of the big arguments is that these private credit players have big software exposure. So 25%, right? And it makes sense over the long term. Why it's the same reason why investors love Salesforce, Workday stock, et cetera, is because this is sticky, reoccurring revenue, right?
Yep.
And that is what they looked for. And so they are exposed, the private credit players, to that software space. And the argument being made is that, well, look at what the public equity market has done with those software stocks, down sometimes 30, 40, even 50% in extremes. Why have you not seen a reaction in the price of private credit? It's coming. They're going to rug pull you.
Right.
And I think that is just a dramatic misunderstanding of the difference in equity and where you sit on the capital structure in private credit. So there's two things. One, private credit is the top of the capital structure, right? So you need this thing to completely go default and there be nothing left at the end of the day.
Right.
And that is how you experience pain on a private credit loan, right? So it eats through all the equity. So these founders that have launched these companies and poured their blood, sweat, and tears into them, they need to go kaput, right? And then it eats into that senior secured debt, right? The other piece of it is a lot of these are private equity backed. So they have the backing of a Blackstone, et cetera. The Blackstone really wants that equity not to go to zero. So they're going to step in with their funds and backfill.
Right.
But the biggest nature and the difference between the two is the length and longevity that the investor needs to think about them through. So you have a difference in terminal value on these software companies, and that is what you're getting a reaction to in the stock price. And what I mean by that is 5, 10 years out, when AI agents can step in and do some of this CRM type work that is overly simplistic, which is what they're making it out to be. Okay, so now you have cash flows getting hit 5 and 10 years out. And so therefore the terminal value of the company is lower. And that is why you're having equity prices re-rack lower. These loans are 2 to 4 year loans. You need meaningful impairment and cash flow in the next 2 to 4 years,
right,
in order to see real distress in that private credit space. So at the end of the day, like private credit, broadly speaking, little secret, everyone, it's positive year to date.
Yeah.
With all of this noise, So I'm not making the case that there isn't some private credit loans that are out there that aren't good.
There are clearly some bad. Yeah, clearly.
There are. Don't get me wrong. But I think that this overblown hysteria that's taking place in the market, and listen, they're gating, right? They're gating, which means investors cannot get their money back. Yeah. That is not a bug. That's a feature. Right. Yes. That is what you pay these companies to do, is protect me as a shareholder from Michael and every other shareholder saying, I'm out, forcing the portfolio manager to sell at distressed valuations and return capital. And that's just not what they're meant to do. They're going to gate, and they're going to allow this loan to continue to make the payments, which the companies currently are. They're going to continue to have the performance trickle on as it did. And that's why the performance is positive. But I get it. Investors don't like it when they say, hey, you can't have your money back.
Yeah.
And I love the fact, an amazing headline.
Yeah. I love the fact that you brought up Gate. I actually brought that up. I read an article, shout out to Lance Roberts. He wrote a Substack called Subprime Crisis 2.0, Will Private Credit Be the Trigger? And it was a rather long article, but I read it. And really there were kind of two things. One, you brought up Gates. And again, we're trying to compare this to 2008 because everybody thinks the next GFC is coming. And one of the reasons the GFC happened is because there were no gates on the loans. So when everybody sold, it was literally a movie theater on fire with everybody running to the exits. And that was a problem. So gates are a feature, not a bug. The second thing, and this is wild to me, we had about 1.2 trillion in subprime loans in 07-08, about 1.2 in originations. Unfortunately, because of CDOs and synthetics
of the derivative, that
1.2 became 62.2 trillion.
Yeah.
To date, we have 1.7 in private credit.
Right.
There is no derivative of a derivative of a derivative. So we are exactly 3% of the chaos of the GFC plus gates. So it's just not.
And by the way, if you're worried about private credit, which is senior secured, top of the stack.
Senior. Yeah, exactly.
What should you probably be a little bit more worried about that sits beneath that,
equity.
Which is a 4 times larger asset class, which is private equity, right?
Yeah.
And I'm not making the case that private equity, you should be running hair on fire, getting crazy about that either. But that goes first before the credit side of things go first. That is a function of corporate structure and the capital stack. Exactly right. So, and then you have people come out and like, so let's talk about a couple other things here. So if you look back at 2022, private credit was the all-star of all investment asset classes in the nastiest fixed income bond market that we had literally since the Revolutionary War. Private credit's up 10%, right? In the nastiest of nasty environments. And so, but what happens is the narrative starts to get blown out of proportion, and then every media outlet starts to play on it. And then everyone becomes this expert because they read 3 recent articles on private credits. Right. And all of a sudden the doom and gloom starts to take place. And then you have someone like Jamie Dimon step in and say, hey, we've got one cockroach, which was Tricolor and First Brands. There's lots more out there. Well, guess what? Private credit is taking the business from JP Morgan Bank. And
Yeah.
so therefore, private credit is taking investor capital and going directly to companies, circumventing the bank that sits in the middle, typically taking a 3-point spread on it. So
Mm,
what is Jamie Dimon going to say? He's trying to
he's-
protect his business and
yeah.
create this big obnoxious thing over here that's private credit to force people back through the banking system so he can do more business.
Love
There's
it.
incentive.
Yeah. So he's talking his book. Shocking. Jamie
Yeah.
Dimon would
Yeah.
do that.
Yeah. Yeah.
I'm shocked.
Yeah.
Nobody ever does that. Well, the final topic I have on my laundry list, we crossed everything out except for AI and job losses. Obviously, a big headline a couple weeks ago, Block whacking 40%, rumored 20% at Meta. Where do you come down on this AI? Are we going to just lose all entry-level white collar and just everybody's got to become a plumber and electrician? Where are you at this AI apocalypse?
I, as a kid that grew up in a one red light, blue collar as it comes town, I love the hysteria that you see when a white collar job comes under pressure. Like, the rich people are going to get fired, and all of a sudden, everyone loses their goddamn mind on Wall Street, and they're like, "Hey, wait, they're coming after me now." Before, when it was an economic slowdown, like we were all good, but maybe we didn't need to build the next house, and the construction worker got fired.
Yeah.
Now they're coming after me. This sucks. So, I think that there's some hysteria playing out there. I do think that we have efficiencies in the business that we run through AI. I don't know that it's necessarily the kind of mental capacity side. I think it's more of the, hey, we track all of this economic data, and it used to take us going out and farming it ourselves and finding each underlying data point. And now we can throw it in Claude and have all that data sucked in immediately. Right now, we still have to digest it and understand what it's telling us and interpolate that data into making decisions. But I do think that there is that kind of college grad type role that probably has a little bit more pressure where people start to second guess. Hey, I know I'm not great at AI just yet, but I think we're getting better. And I think that we can systematize some of this stuff to not have that next, 22-year-old hired for 50
Yeah.
grand. Instead, pay $5,000 to some AI, kind of Claude type system and have it do it effectively, know that it's coming from right sources, know that the data is being calculated correctly, et cetera. I get it. I get it.
Yeah. Well, where do you, when you step back and you look at, let's say you're looking back at AI in a decade,
Mhm.
do you think AI will have destroyed more jobs or created more jobs in total?
Because of human nature and because we have done this so many times, the internet's going to get you fired. The locomotive, the car, the tractor, the whatever it is, I think it's going to create more jobs than it destroys.
Yes,
In
I
short
agree.
term, I don't know that you can necessarily say that, right? Over time, I think that's where we wind up. In the short order, we start to replace some jobs with it.
Yeah, I think that's exactly why I said a decade, because I think a decade is long enough for us humans to do what we've always done, is create the next, the next thing. And you're right. I think in the short term, I mean, if you put short term like 18 months, I'm not taking that bet. 18
No.
months,
No.
more job
Agreed.
losses.
Who is this asshole from Anthropic that's the CEO that keeps coming on? Who is their PR person
I don't know.
that's allowing him to say that we're going to replace 50% of jobs or whatever dumbass thing he's saying? Like, what do you do? You think you're doing good by your company doing that?
This is what I think's going on is all of these AI folks are trying to raise money.
Yeah.
And the only ROI they have is labor.
Yep.
So they're saying stupid things like that, not realizing I don't even think they believe it. I think it's the only way they can go get the next $100 billion.
Well, it's hysterical right now to see Sam Altman flail.
Yeah.
I mean, one, he just comes off as a PRICK, and I think that everyone roots against him.
Yes,
But he now, what you're starting to realize that ChatGPT has become more of a retail-driven user base.
Correct.
And we all know that the big money comes when you can get corporate adoption. And Anthropic is eating their lunch there. So what now ChatGPT and OpenAI and Sam Altman is doing, they're saying, hey, private equity, we'll guarantee you a
17%. Yeah, or
17.5%, right? And so what they're trying to do there, it's not stupid. I mean, it's crazy, but it's not stupid. What he's trying to do is he's trying to get the buy-in from those private equity companies to invest their capital there, because what they're going to do is they're going to force it down the stack on all of their underlying companies. So
Mhm.
you're going to create demand, that's
Yep.
sticky corporate demand by that private equity company that purchases you, to
Yep.
then force it down on their underlying companies and have them be your user base. And by the way, AI learns with data, right?
Yeah,
So the
it's gonna
more use it
backdoor it.
is, the
Yep.
better it gets. And the snowball and the flywheel keeps turning. So it's a creative, kind of harebrained idea. I don't know. And when you look at the terms of things, like, I'm sure it's not literal guarantee of 17 and a half, like the,
Yeah,
like,
there are
like,
plenty of outs, plenty of
yeah,
outs.
there's plenty of outs, right? If the company does well, we'll guarantee you 17 and a half. Or you'll get preferred performance over the other shareholders, et cetera. But at the end of the day, like, it is a crazy headline to say, hey, we'll guarantee you 17 and a half. Like, what moron wouldn't take that?
Yeah, no, there you go. Well, I don't have anything else on my topic. Something did come to me, though. I wanted to ask you. I always do this to you, try to put you on the spot. What do you think the chances are of a recession being declared in the next 12 months? 0 to 100.
Yeah, I think it's still light. I think it's still light
Oh,
around 25, 30%.
ooh, wow. So
Yeah,
you're with what Goldman Sachs, I think, recently said when upped it from 20 to 30%.
yeah.
So,
I
okay.
I I just think that the US economy, and granted, like, if the global economy catches a cold, like, we're gonna get it too, don't get me wrong. But I
Yeah.
think the US economy right now is in the driver's seat because
We
of
are
our.
we are very insulated from this,
Yeah. Yep.
comparatively speaking. Yeah.
Yep. Yeah, it's
I
just our energy independence, that, and not only energy independence, but, like, now you're also starting to see European countries go like, "Hey,
Can we get some of that?
should we continue to go to Russia for this? Because
Yeah.
they've proven to be bad actors. And now, by the way, the Middle East, like, maybe we can't
Yeah.
get that quite as cheap as what we thought we could, and maybe we pay a little bit more to have a better partner long term."
Yeah.
And you know,
Yeah.
politically, I don't know that we're making friends out there right now, but I still think that we're perceived to be a better player than both those other two alternatives.
Yeah, I think of all the craziness, we're still better than those two. I agree with that. Well, I'm curious, do you have anything else that's top of mind that you're thinking about,
No, you
before we
put
did
together
this?
a laundry list there. That was impressive. We banged down through 8 or 9 topics
Yeah.
very quickly, and they were all kind of top of mind. I thought, as always, I appreciate the heck out of you, because you read and you study more than anybody else in this
I
space. So
I
congrats to all the success you've had. Well deserved.
I appreciate that. Where can people find you?
Yeah, find us at Life Goal Investments on whatever platform you watch. We're there at Life Goal Investments, doing daily 60-second type videos.
Yeah, you gotta definitely check him out on Instagram. It's one of my sources. It really gets me thinking. I don't know how he shoves 10 minutes of material into 60 seconds, but he does it each and every day. Give him a shout out, Life Goal Investments. Thank buddy.
You're the man. Quick ask. If you're enjoying the show, hit the follow and drop a rating. It helps more folks find our podcast. Thanks so much.
The information discussed in this video is for educational purposes only and should not be considered investment, tax, or financial advice. Investing involves risk, including possible loss of principal. Always consult a qualified financial professional before making any investment decisions. Past performance is not indicative of future results.